Good afternoon and welcome to the evening video for TheoTrade. I am Blake Young and today is February 27th, 2023, and today we're going to be discussing durable goods orders forcing economy into the slow lane. We're going to be talking about the idea of the durable goods order as one of the biggest indicators of big ticket items. Manufacturing orders that go through durable goods orders are defined specifically as any product, hard products, physical products that have a life expectancy of over 3 years, such as computers, appliances, cars, and for large corporations and government, that would include airplanes, both defense contract and commercial airplanes such as the ones we fly on. So as we're looking at this data, the durable goods orders missed dramatically. We saw it go down 4.5%. So month over month, last month, we had over 5% durable goods orders. This month, we had a drop of or a compression of 4.5. So major fall and a major dip in orders that are pushing us into the negative. Now, does that mean that the big ticket items, that people are afraid to buy the big ticket items? I think initially, if you look at this data, that would say yes. We would look at the data and say, if we're seeing a drop in 1 month of 4.5% and a difference from the previous month, arguably, of 10% differential, that is a major shift in the desire to purchase big ticket items. And that might make us nervous because this should be feeding into factory orders and therefore factory workers. And it could be a major indication of the economy moving into the slow lane. But if we look a little bit closer, it's not as bad or it's not as grim as we might think. It is specifically grim, but not grim overall, is not as bad as we might plan for the entire economy. So let's take a look at a little bit different data from Fred. If we look at the manufacturing for new orders, again, durable goods orders, and we take out aircraft, this move through here, climbing up, you can see that we're kind of flatlining up here, but we're flatlining way up here at the top. And so the increase, we actually saw an increase if we take out aircraft. If we take out aircraft, non-defense, and we focus on taking out aircraft, we actually had an increase of 0.7%. So there is a slight increase, a slight improvement in durable goods orders, which would indicate that we are buying stuff for businesses, buying new appliances, and we're still buying cars, possibly because car prices have pulled back a little bit, at least in the used car market. So when we're looking at this, it appears that all of that big move, was driven almost exclusively by aircraft. Specifically, we're talking about a major decline in Boeing's orders. In December, Boeing received an order, or orders, contracts, for 250 new contracts, which was the 5% surge in durable goods. When we leave aircraft in there, that spike in December caused Boeing to climb and climb and climb and climb. That big order from all the major airlines pushed Boeing up. And you can see the orders in December, you can see here we are trading in about 180. We climb and climb and climb, hit 221. But now those orders have been placed. January's orders for Boeing were only 55. So it's not just that we saw a major drop, it's that they've already fulfilled on their orders. So Boeing is not getting knocked down or clobbered today. It's just we've already placed all the orders. Now the question that I have is that going to feed into the big airlines? Are we already seeing the slowdown in orders from Boeing because they already had placed their orders, they're already done, and now we're not really pricing the same amount of growth? If I jump over and look at the ETF that represents airlines and look at jets, you can see this looks very similar to what Boeing does. We have the run up in December, spiking up and climbing up to these highs and pulling back in a similar resilient move today. So all we're really pricing in is a difference, a comparative difference from December to January. We've placed the orders have gone out, they've now impacted the airlines from those orders showing that we have demand, we're expecting more growth, they needed more airplanes, Boeing is going to fulfill the 250 contracts, and so Delta looks like jets, American Airline looks like jets, all of them look like Boeing, and so we're still seeing these move in lockstep on that rally in December and the holding up here near the highs in January, or January into February. So the core durable goods miss is not as strong of an indication that we're seeing a slowing as far as consolidation. Reality is, it was that all the other information didn't move. That automobiles closed up 0.2% as far as orders go. That's nothing. That's non-growth. We're just not seeing that much move. It's primarily been in business orders, which increased by that 0.7 and 1%, and that was enough. Not a lot of growth, but it's stable. It's not an indication of the end of the economy. What really drove this move again from 5.1 to negative 4.5% comes down to that non-defense aircraft and parts dropping 54% from the previous month. That is not just because we saw it drop, it's because we saw a huge spike in December. Now, as we look at some of the additional information you can see through here, this is just some of the breakdowns of the orders. We're watching some of the things like orders here increasing by 0.8%. That's a good proxy for business spending. And manufacturing machinery rising 1.6%. Again, that's good. Computers and electronics are only up 0.5%. Again, cars, 0.2%. It's more of an indication that we're in a holding pattern. So despite that major miss and what could be perceived as the next leg down in the economy, it's not. We're just holding. Now, the fact that we're holding here with higher interest rates, again, is a good sign that we're still spending, even with the higher interest rate costs. I believe in the future months for durable goods and core durable goods, it's going to be more dependent upon the dollar's purchasing power, not just against a basket of currencies, but against gold, silver, and other hard assets. So as we're watching the SPX, we've gapped up and closing down. We're filling that gap today, showing that today's bounce was not sustainable. We haven't broke through the near-term support, but we also haven't rallied off of this enough to consider it a bullish bounce. I would be watching for these lows and possibly this low to be breached before I believe that we're in a longer-term downtrend. But I'd also say that we have to clear this high for the year before we are truly in a continued uptrend. Overall, I think we're consolidating in the same price action that we have been in arguably since November. We need to see whether the dollar's purchasing power, with the changes in the interest rates, with the changes of supply and demand, whether we're going to see a continuation or a contraction of the economy. If we take a look at the dollar index, the DXY, and its purchasing power, we've rallied significantly off the lows, but we're in that same holding pattern from November. Now, a little bit later in the game, we could see the dollar strengthen a little bit more to get to the same November pricing, but this is a solid rally for the dollar off the lows. And when we see the dollar rally off the lows like this, historic price action or historic ratios would indicate that we should see a similar 2.5 multiple drop in equities as the dollar climbs. If we were to measure this as a percentage, we should have seen about a 4.5% climb in the dollar and a pullback to about, we'll just call it 4%. I know it's 3.8, but if we go 4.5%, then we should have seen that 2.5 times multiple, which should have seen an equity dip of more than 10%, about 11.5%. Going back one more time to the SPX for that same time frame, from its peak, have we seen a drop of 11%? Short answer, no. We've only seen about a drop of 6%. We've recovered and we're down approximately 5% right now. So 5% from the highs is tolerable, sideways, there's the bell, tolerable and sideways through here. And the question is, again, is it going to be seen in other assets? If we go take a look at gold prices have faded from the high, have dropped back to the November price action, similar to what we're seeing in the US dollar, similar to what we're seeing in equities, and the move from the high to the low right through there is about 8%. So we still have some potential downside to gold, some potential downside to equities if the dollar resumes its bullish trend. Even if it's just going back up another 1%, the US dollar could see another 1%, possibly higher. While we should see gold prices fall back into the 1770 area, we could see equities fall all the way back, another 5%, just to get the entire percentage move, which would bring us down to about 3,700. If we go from the high to see that 11.25, 11.5%, we're talking about into the 3,700 range. Now, again, that's another 5% plus from the current price action. That's what will be required if the dollar continues to gain. And that's an if, totally an if. Right now, durable goods are still happening. If we take out that huge spike in airline or aircraft orders in December and look at it from a holistic, bigger view, we're stable. The dollar's stable in its purchasing power. We're stable in our durable goods orders, our manufacturing. And in March, if we see the rate hike of 50 basis points, that could be the catalyst and is likely the catalyst that will push core durable goods down, will push equities down, and the dollar up to a multi-month high, possibly pushing us back into October or September highs that we saw earlier. And one more chart to look at that kind of ties it all together is copper. Copper prices are my favorite indicator to indicate whether we really have demand or not, specifically in the manufacturing, because there's a lot of copper used in computers, personal electronics, cars, and certainly aircraft. And so we see copper prices have pulled back from the high. Now, I don't think we need to anchor to that highest of high. If we anchor from the most recent high, excluding the 1 day, then we're about 8% lower, very similar to what we just saw in gold prices. If we go to the lowest shadow, about 8.5%. And this would be another indicator that if we see copper break through this low, we should see copper drop back down to 3.7, if not 3.6, and that would bring us back to November's price action as well. And so they seem to be very, very complementary to say, if the dollar strengthens, copper, gold, and equities still have anywhere from 2 to 5% drop just to get back to the same levels as the ratios the dollar continuing to climb. And if the dollar continues to climb, then it's going to be more expensive for people to borrow because we're going to see the higher interest rates and we're going to see likely a slowdown in the future. But if we hold right now, this is sustainable. And it's what we'll watch. We'll watch as we get closer to that March Fed meeting and the next rate hike. That'll do it for today. Thanks for watching. We'll look forward to talking to you next week, same time. And we'll talk then.